Welcome, everyone. This is Andrew and Jacob with Motel to Apartment Conversions. We are thrilled with our brand new property under contract, this 121 unit hotel conversion project in Houston, Texas. And we can't wait to tell you all about it. Take a look at this screen when you get a chance. Remember, you should always consult your independent tax or legal professionals or advisors prior to making any investment, including this one. Just a legal disclosure for you. And as you already know, we are motel to apartment conversions, which includes the gentleman at the left, the three gentlemen at the left, this myself, Jacob, and Richard. We also have an advisory member, Ross Hubbard, who has done a sundry of deals just like the one we're about to show you today.
Great, thanks, Andrew. So for this deal, these are our projected investor returns. So we're targeting a 35% internal rate of return IRR. We're targeting a 2.28x equity multiple, a 42.7% annual rate of return, and the hold period for this project will be 24 to 36 months. So those are the projected investor returns that we have, and we'll go a little bit into more detail here soon. For the terms, we're offering an 8% preferred return to investors, and then an 80-20 profit split after the preferred return. 80% of the profits to the investors, 20% to us, the GPs. In terms of fees, there's a 4% project management fee, a $150,000 acquisition fee, and a 0.9% asset management fee, and then a $30,000 advisory fee. And so if you look into an example $100,000 investment, if we were to hit the goals of our pro forma, year one, a $100,000 investment would yield close to $12,000, close to $12,000 in year two, and then year three, $204,000. And so the total project return, including the return of capital for a $100,000 investment, would be $227,000, almost $228,000, including the return of capital. And so we think our estimates and our performance is very conservative, and so we feel confident showing that this could be an example $100,000 investment. And so just to recap, we're buying this property for $3.6 million. It's approximately $30,000 a door. We'll be putting $22,000, $23,000 of rehab into it. And so all in, we're at $53,000 a door. Our exit sale price target is $113,000. And so, and again, that's pretty conservative. We're going to go through the numbers here soon. But if you look at all in what our cost is and what we're looking to exit, I mean, it's over double. We feel very good about that. And then a 35% IRR, 2.28 equity multiple, a target hold period of 3 years, and then an exit cap of 7.5, which again is very high for the market, meaning that we're taking a very conservative approach. So the property is, if it were to follow market value at a 5% cap rate, it would be worth much more than we're saying here.
Property is in excellent shape, actually. Minimum renovation is needed. Originally, this was a 220 unit Holiday Inn back in 1983, which was condensed down to 120 units in the 90s. So all we have to do is show up and finish up and replace what needs to be replaced. What I mean by that is replace the countertops, replace the cabinets, add paint, add some flooring. There's 34 studios. There's 87 one bed, one bath already set up, and they have large units with kitchens. And this is just a prime location in Houston. You're going to see that the Houston airport's nearby. It's not even 15 minutes away. It's not too close, but it's not too far away either. And obviously you have plenty of shopping, plenty of retail nearby, Starbucks, Chipotle, Panda, Walmart, a lot of the essentials for all of our residents. We love Houston. Houston is booming and bustling. And 20, 30 years ago, it was an oil town. Now it's got tech, it's got hospitals, medical, retail, manufacturing, and it's just growing. It's very business friendly, and that's why we're seeing a massive growth in population and low unemployment. And we are seeing a big boost in airport traffic, especially in the last 2 years, and it's still consistent. GDP growth is there as well, and we have a less than 10% vacancy. These properties are staying full. People are moving in. People are moving in from other places, especially other states. And there is a rent growth, an actual, not a estimated, an actual 1.5% year-over-year rent growth, and we see that as being consistent as well. Let's talk about the debt market today. Such a red and bloody screen here. It's not good. Today is October 17th, 2023. Put some just to put a little context into when we're making this, but it's not great. We actually worked with a few brokers. You can even see the red glow off my face. It's great. We talked to a few brokers and a few lenders, actually many, and we're seeing approximately 11.5 to 14% interest. Terrible. They're gonna rob your kidney and your firstborn. And at 2 to 4 points at close, 2 to 4% of the total loan size goes to the lender at close, obviously. We're seeing variable interest. Their lenders are not wanting to fix anything right now. It's just so unsure. Typically, it's 4 to 5% above SOFR and with high ceilings. So it's kind of like you never know what you're going to get when you lock it in. It can change. 2 to 3.5% prepayment penalty, which really hurts the deal. And there is an actual penalty called an inactive capital fee that one particular lender we were talking to is going to assess. And that means if you don't spend the money when they want you to spend it, or when you don't push the project at the right time, or you leverage the tranche of capital they're going to send for the project capital at the right time, or how they want you to do it, they're going to charge you a fee for that, if you could believe it. And this is the worst. The absolute worst is most of these lenders, and I would say most of them, 80, 90% of these lenders wanted all of our investors to sign a personal guarantee. And that was never going to happen. We're never going to allow our lender to have you, if you're watching this, sign a personal guarantee unless you are a specific credit partner on a particular deal, which we could discuss later. But that was the nail in the coffin for us to use the current debt market opportunity today. So we actually converted this deal into a much better deal, and Jacob's going to talk about it.
Yeah, exactly. So we had the opportunity to take on debt like that, but we made the conscious decision as a company to try to stay as far away from debt as possible, from bank debt as possible right now, just because it's a toxic market. And so for this deal, we negotiated a great seller finance option. So we're acquiring this property under a seller finance acquisition. And so the seller is carrying 72% of the purchase price for us. There's no personal guarantee. Investors don't have to, put their butts on the line for this. There are no hoops to jump through. There's no loan origination fees. There's no prepayment penalties. I mean, we love seller finance, and all the deals that we're going to pursue are going to be seller finance deals. And so it's a $3.6 million purchase price for the property. It's about $30,000 a door. We're giving the seller $1 million down payment, and we locked them in an interest rate of 7%. It's a 12-month term, and the great thing is that we're actually paying all 12 months up front. And so after we close, we'll have no debt payments during the entire time of the renovation. So it takes a lot of pressure off us, and it allows us to be able to budget for renovation appropriately and get through the renovation process, which Andrew's going to talk about. Close of escrow is December 1st, 2023. And overall, we're very confident in our seller finance strategy. We think it sets us apart. We think it's going to be a strategy that's more and more important as time goes on, and as the debt markets either continue or stabilize. We just want to pursue seller finance. So we feel very good about the arrangement that we have.
We love the low risk, and that, by the way, that 7% is less than prime, and especially when we're doing construction. So great deal. Our proposed rental project timeline is as follows. We're going to be buying the property here in Q4, excuse me, of 2023. We're starting our cost segregation study to help our investors save even more, and that's with Madison Specs. We're gathering our materials in our material procurement stage and storing them on site, and then we're building labor contracts. In Q1, we're starting to renovate the 1-bedroom, 1-bath units. We do have a program, a discounted rollover program. If interested, you can always contact us, and it's where there's a discounted rollover transferring funds from your IRA to a Roth. And there's more info If interested, let us know. And then we have a lease up strategy that starts now. These rooms, these apartments, as we mentioned before, they're ready. They're ready to go. We're going to set apart a certain quantity of units to be renovated. And while we do and it's not heavy renovations, remember this is cosmetic. So when we set apart a certain amount of units to be renovated, we can still lease up what's existing. So we're not losing cash flow, which is really unique in our strategy of motel or hotel conversions. In Q2 of 2024, we're finishing up all the one bed, one bath apartments. We're going to begin our studio apartment renovations, which do include adding, I should say, repositioning a floor plan just a bit, slightly. They already have the kitchens, they already have that build out. We're just adding a little bit of electricity. We're going to be finishing up the studio apartments. We're going to order and send in all of our inspections and get approvals completed with the city. And then we start our full lease up of the property. In Q4, we refinance with full occupancy. This is the vision. And as you can see on the screen, this is obviously a rendition, but it's not too far away from what the actual unit looks like as far as the floor plan goes. We're going to upgrade the kitchens. We're going to be removing a drop ceiling, again, cosmetic. We're doing some modern cosmetic upgrades and furnishings, and obviously adding energy efficient fixtures. And as you can tell, the floor plan doesn't deviate tremendously from what the after photos appear. Beautiful
Absolutely.
property.
Yep. So for our leasing strategy, we have an internal property management team, and it's all set up. It's running on our other properties right now. And so everything is in-house. And we are listing these apartments on apartment rental websites, Zillow, apartments.com, etc. The goal is to have 12-month leases for these apartments. The target demographic are singles, couples, seniors, even small families, especially because these apartments are, the majority of them are one bed, one bath. And so there is room for a small family, a family of three, even a family of four. But in our other apartments, we see lots of singles, couples, seniors, working professionals. There's a high demand for all-inclusivity in this area. There's a great comp that is literally next door to this property that's bringing in almost $1,700 a month, which is well below what our pro forma says that we can collect. So we are targeting people who want very nice living, A-class living is what we call it, at an affordable price point. And so like Andrew said, we're going to be leasing up right away while we're renovating. We expect no less than 60% occupancy year one, and then stabilized occupancy 92% year two and year three.
The property next door, as you can see in this highlighter, yellow, in-town suites, is one that I actually visited myself. I walked in there, I asked all the questions, and I'm talking literally next door. When people say next door, sometimes they're meaning down the street. This is literally right next door. It was an old motel, an old hotel, and they're less than 300 square feet each. And they converted it into apartments, just like what we're doing. Now they're almost half the size of our units, and they're getting $1,697 plus a month. And it's just absolutely wild. And then you have some other comps here that are still in that 13, 14, 15, some $2,000 range, where we sit at a conservative $1,381 a month, and that's all inclusive. That's sewer, water, trash, electric, internet, everything. Again, the property next door, in-town suites, wouldn't say truly a competitor because our operations are a little bit different, but as far as the footprint of the property, very, very, very similar in exact comp. 95+% full, again, less than 300 square feet a unit, which is almost half the size of our units on a whole, and they are bringing in over $1,500, over $1,600 monthly. And here's the kicker. When I walked in and asked how many rooms they had available, how many units they had available, it was 3. And today it's 1 to 2. They don't have much available. They keep filling up very quickly in the line out the door. Our exit strategy is simple. It is to sell to another company that we control and we manage called ParkRise. ParkRise purchases these stabilized assets, in which if you're watching this and you're interested in being an investor, part of ParkRise, please get with us and let us know. We'd like to clue you in and find a way to have you be a part of it. But it is to sell to an entity that we already know is going to buy it. That's one of the beautiful parts about investing with us is you already know who your buyer is going to be. With a disinterested BPO, third-party broker price opinion, they will take a look at the actual value and it'll be purchased and we exit. That's how we're able to exit so quickly.
Exactly. So you can download our more thorough offering memorandum presentation on our website. But this is just kind of a recap of what is listed in CoStar. The cap rate of the properties in the Houston area, we're looking at 4.7% average cap. We underwrote this property at a 7.5% cap rate. So we're almost 3 points above what the market cap is. And the reason that we do that is so that we kind of plan for the worst case scenario. We want to underpromise and overdeliver to investors. And so our price per unit is $113,000. The average for the area is $124,000. And then the median vacancy is 7.5%. We're projecting 8%. And so again, we expect to be closer to market. We just put these numbers in order to stay conservative, to protect our investors, and to underpromise, overdeliver, like I mentioned.
Thank you for joining us today. We invite you to invest with us. Please reach out to us when you can. You can email us info@motelstoapartments.com. Our offering is open to all who are accredited investors, and the total equity raise is $4.8 million. Thanks for joining us.
Thanks.